So investing can feel so overwhelming, especially if you're just getting started. But what if I told you that building wealth doesn't have to be that complicated? Now, today I'm joined by Frank Buchholz, a retired senior vice president and financial advisor with over 40 years of experience helping people achieve financial independence. Now, Frank has a gift for making investing simple and accessible, and he's here to share practical strategies that anyone, no matter their income, can use to start growing their wealth. Now, again, if you've ever felt like investing is out of reach, this episode is going to be for you. Let's dive in. Hey guys, welcome to today's show. I am Brad Nelson, founder of Debt Free Dad. I paid off about $45,000 of debt. I've been debt free now for more than 11 years. I've also helped thousands of other people save and pay off tens of millions of dollars with the work that we do here at Debt Free Dad. Now, after listening to this episode, if you're ready to take things to the next level, you're ready to break free from living paycheck to paycheck, you want to reduce financial stress, you want to build your savings and finally pay off that debt for good, but maybe you're like many of us, you're not really quite sure where to get started. Now, we've created some incredible free resources here at Debt Free Dad to help you get there, and I'll be sharing some details about how you can get those later on in today's episode. So, hey, Frank, how are you? And welcome to the Debt Free Dad podcast here today.
Good. Thank you for having me on. I appreciate it very much.
Yeah, absolutely. So what brought you to the investment industry? Now, I mentioned in the introduction, like you have a lot of experience. We're talking several decades, like 40 years. What got you into this to begin with and helping people with investing?
I always found the investment world to be a very fascinating area, if you will. And even in college, my major was business administration with a finance minor. And I did take several investment classes with a gentleman by the name of Dr. Neil Pepper, an easy name to remember, of course. And he was inspirational because he was brilliant, number one. Number two, because he could actually figure things out and present things in such a way that made sense to me. So after graduating from college, I did have a couple of jobs before I got into the investment world. It's hard to come out of college as a 20-year-old and hop into the investment arena because it's kind of challenging, to put it mildly. So I started in 1982 when I was 30 years old. And so here I am, 4 years later. And candidly, you learn a lot over time. So it's been a very good career. I did meet a lot of very interesting people.
Yeah. You mentioned the person that you were learning from was able to present things in a more simple way. And you mentioned that word simple when, helping people understand and teach people about investing. Can you share with me, as a new person to investing, someone who's just getting started, what are some of the maybe bigger misconceptions or things maybe they don't completely understand, maybe from outside influences or social influence, but what do you feel people aren't grasping when they first get started about investing?
I think the biggest problem I found with most people is they don't have a clue when it comes to investing about what investments are all about. They're very challenging. It's not they're not smart. They've never studied it, understood it. And so in my book, I try to make it more of a non-college textbook where I have actual life experiences with clients, so they can actually see what people did that made sense and also illustrate it in such a way that do things they don't want to be doing. So it makes sense from that standpoint. So
Yeah.
The bottom line is the fact that I wouldn't say it's very complicated, but you need somebody to kind of guide them. And my goal with the book, of course, is to present things in such a way that made sense. My clients over the years complimented me on the standpoint that I could present something that's complicated and boil it down where they can understand it easily. And I was also made sure I never intimidated clients by using all these fancy jargons. Standard deviation, SEC, and yield to maturity, and blah, 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 all that nonsense. So you got to boil it down and make it simple. So that's kind of where I was at with it.
Yeah. And talk about that. And I don't want to get too much in the education side, but the whole, we need to be educating our youth about money and personal finance, especially investing, even in high school years and things. Why do you think, number one, why is that so important? But number two, what's keeping schools from actually teaching this stuff at such a young age? Because as you know, the value of investing, especially long-term, is getting started early. And too many people get started late, or because they just don't understand how important this is to start teaching kids this stuff. And maybe at least your opinion on why aren't they teaching people this stuff?
Well, that's a good question, because even in my case, I didn't learn anything about money until I got into college and I was taking finance classes. So if I had taken finance classes, guess what? So interesting enough, in California, they finally are going to put a money class, if you will, in the high schools here. It's coming up the next year or two or what have you. But that was actually going to be a ballot proposition, but they finally approved it through the legislature, thank God. So at least a little more people become more aware of this. And the bottom line is the fact that currently half of people in America retire with no money saved for retirement, which to me is a crying shame. Crying shame. If they're going to live off Social Security, good luck. So, there's a crying need out there. And my goal, of course, was to provide a roadmap for people to understand easily the value of starting early and also what to invest in so that they can retire without any debt, without any money worries. Because when you get older, you're going to have issues no matter what. You have issues with health or whatever. Well, if you compound that with money worries, it'll make things worse. So in my case, thank you very much, Scott. I'm telling you, I retire without any money worries. That's my goal for every person in America.
Yeah. You mentioned debt. Let's talk about that real quick. You mentioned the word debt. And when people are starting to first think about investing, in your 40 years of experience, what is your philosophy in talking to people if they have credit card debt or student loans or auto loans or things like that? Like, how does that fit in to their overall strategy in investing? And do you recommend, let's take care of this stuff first so you have more money to invest, or what are your thoughts there?
Yeah, so bottom line, of course, is in my case, I only borrowed money to either buy a house or buy a car. And of course, I was borrowing money from my employer, so I was pretty darn careful to make sure I paid them back, if you will.
Yeah.
But my credit card debt, would pay the credit cards off every month. So having said that, a lot of people, young people these days in particular, have a tendency to live for today. And they kind of, tomorrow's way off, I'm not going to worry about it. But nobody's ever really explained to them in great detail about the concept of saving and investing today. And I try to drive that point home in my book over and over and over again. The sooner you start, the better off you're going to be. So as an example, I did some work. I have a website I came across. If you invest $10 a day over the next 36 years and have the same returns you did over the last 36 years in the stock market, which is 10%, you'd have $1,264,000. And your investment would have been about $110,000. So you would not only get 10 times your money back, but you'd also, of course, have a return of 10% per year. So it's concepts like that drive the points home. $10 a day is $300 a month, obviously, but still,
Yeah.
$10 a day, they can forego something, whether it's 2 cups of coffee at Starbucks or what have you. So it's important to start now, not later.
Yeah. I love that you bring that up. I could go so many different directions with this, Frank. I'm on social media. I'm on TikTok. And I talk about this stuff. And one of the TikToks I recently just did, actually just a few days ago, that blew up, has nearly almost I think 750,000 views now. And
Wow.
I asked the question, if things are so bad and people are living paycheck to paycheck, because you brought up Starbucks, like, why is it that the Starbucks line is wrapped around the building? Or why are they able to sell out concert venues and sporting events? And why are shopping centers packed full of people still if people are struggling so much? But I think people sometimes have this misconception: if I need to invest, I have to invest a ton of money to
Right.
have any sort of money at the end of the day. But you're mentioning all it takes is just $10 a day, something like as minimum as $300 a month to get started. And in 35 years, you could have over $1 million. That's pretty awesome.
Pretty powerful stuff. And of course, what they can do literally, if they can buy what they call, the ticker symbol is SPY, which of course is an exchange traded fund, a bushel basket full of stocks, and it mirrors the returns on the Standard & Poor's 500. And you can buy fractional shares on that through a discount broker firm like our Merrill Edge World or Charles Schwab or what have you.
Yeah.
No charge to invest, no charge to reinvest the dividends, which it's very important to do that, of course, obviously. But
Right.
you can do it in an economical way, and you start off very, very small, and you could, it's perfect for the first-time investor.
Yeah, it's so good. And what would you say to individuals right now? I mean, you've been doing this for 40 years. You've gone and you've seen some historical events that affect investing, affect the market, things like 9/11, the housing crisis back in 08, 09, 2010. I mean, you've seen some things. And now we have a presidential change. Things are changing rapidly, but people tend to have this fear that the world is kind of crumbling around us. And a lot of people maybe fall into more like doom spending, and they're like, what's the point that I can't ever buy a house because things are so expensive? Like, what would you say to individuals who are, especially young people, and as someone as you has seen a lot, what advice would you give to them to help them kind of maybe reevaluate that type of a mindset right now?
Yeah, the first thing to do would make sense would be to actually ascertain how much money you're actually taking home from your paycheck. Not what your gross earnings are, but what you're taking home. And then, of course, Then you can kind of put it on a monthly scale. What are your expenses? And the irony, of course, is that once people start adding up their expenses, they can then, of course, realize that a lot of those expenses are not necessarily important or necessary for their lifestyle. They can forego the whatever. So if they can take just a little bit extra off the top and start investing that, that will pay dividends down the road in a very much way.
Yeah.
So in my case, we retired with no worries. And if I want to do whatever, I can do that right now. So to retire with no money worries, to me, is a real blessing. And it also helps you in terms of just being able to help other people as well. So I think that's the ultimate goal for me as far as the clients go, for sure.
If I'm ready to start thinking about investing, what are some of the first things that I need to look at or evaluate and maybe decide like what I'm going to invest in, how much am I going to put in? You mentioned brokerage accounts and things like that, Schwab. Like that can be a lot for some people. So how do you break this down where it's simple for an average person to kind of start walking through this?
Sure. So, of course, the first thing I would do, of course, is read my book, The Investor's Golden Playbook, which I think would be very helpful. And I'm obviously, that may be a biased opinion, but I think that there's a lot of good information in here, which can be very helpful for clients. And then, of course, they need to take the initiative. They need to say to themselves, okay, I need to get started on this and make things happen, if you will. So that, of course, means contacting some firm, whether it's online or in person or what have you. They need to take the initiative to get started. And if they can kind of get things set up where it's an autopilot, meaning that it's an automatic deduction from the paycheck to go to investment account or what have you, that makes all the sense in the world. Plus, if they have access to a 401k, retirement account in America, that is something they should contribute. And that would be the first thing I would look at as far as doing anything. And what they want to do is try and max that out as much as possible. Currently, a person can contribute $23,500 a year to a 401k, which is substantial. And of course, a lot of people can't do that, particularly starting out. But that would be the very first thing I would look at. Then, of course, on the personal side, then of course you could look at something else as far as growing the money from there. But looking at the 401k, when we managed 401ks at Merrill Lynch when I was there, I was astounded by the number of people that had the money invested in a money market account. And when I left Merrill Lynch, the money market accounts were paying 0.1, and you shoot yourself in the foot because those money in a 401k are long-term monies. Those monies should be 100% invested in the stock market. Now that's kind of, people say, oh my God, it's too risky, blah, blah, blah. Well, it's riskier to have money invested at 0.1 because you want to keep up with inflation. You're never going to grow your money. So you can contribute $100,000 to that 401k and you're going to wind up with, $140,000 when you retire because you're not going to get the interest off that. You need growth. And growth, of course, is achieved by investing in the stock market.
Yeah. Now, obviously, when you start investing, you can use, say, someone like a financial advisor. What's a good way to qualify someone to help you? Because, again, people are going into this maybe with very little education. And what I see, at least for some people, is that they'll tend to put money into things just because they were told to do it, not necessarily because they understand it and they know how it's going to work for them, their financial goals, and their future. What are some things like that an individual, like, make sure you do this and don't do this when either hiring somebody or figuring out what you're going to do?
Yeah, I think the bottom line, of course, is that I would highly recommend using a financial advisor and interview more than one of them. The financial advisor, if that person's good, they will give you information, educate you, and hold your hand through the good times and the bad. So they also kind of act as a psychologist, if you will, because a lot of times people would want to run for the door, and we would encourage them not to do so. And of course, there was one person in particular back in 2008-2009 that ran for the door. And unfortunately, when you run for the door, you're selling at the worst possible time. And of course, did you get back in? No. So you've got to be you have to have somebody to really guide you. And that's why an advisor can be very, very important for you. When you're starting off with just a small sum of money, well, let's say it's even, a couple $100 or $5,000 or whatever, you're probably going to need to do it on your own to a degree because the advisors typically will, have a minimums of, I'd say $100,000 or $250 or whatever. So just starting on your own and just putting your money into a ticker symbol, SPY, is a great way to get started in the stock market. And you can actually see what's going on with that particular portfolio. And it's 500 stocks into one investment. So you're well diversified, great track record, pays a dividend, you reinvest the dividends, get a compounding effect. So you can start with a very small nominal amount of money and set up an autopilot if you can.
Yeah. Yeah. Can you share maybe some common mistakes or missteps that new people will make when investing? Things that we should definitely avoid if we're just getting started.
I think probably one of the biggest missteps is that they don't have a discipline to carry on. I think that a lot of times a financial advisor is put in kind of a precarious position because what happens is that the market all of a sudden goes south, like it's been going this month in general.
Yeah.
And then, of course, the client goes, oh, my God, that investment advisor is worthless, blah, 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 blah. And they pull the money and, oh, yeah, I'm not going to that again. Well, you have to understand it's a long-term process. And you're going to have bumps along the way. It's like being on an airplane. The airplane's going to have air turbulence. You can't get off a plane, guys. You got to ride to the destination. And, of course, the destination in the stock market is, 5 or 10 year window at minimum. So you want to make sure that you have the ability to stick with it and ride it out. So that's a tantamount important. That's one of the biggest mistakes people make, as far as I'm concerned. Running for the door at the worst possible time. I think they should be buying more at that point. So
right. And Frank, you hit it right there. I want to talk about that real quick because it's interesting to me. And I'm not an investment advisor. We don't give investment advice or anything like that here at Debt Free Dad. But it's interesting when you talk to people outside of my business and talk about investing. People always want to buy in to the market when it's doing great because their confidence is high. The economy is great. But the reality is like, you want to have the same mindset of investing, obviously, depending on your age and where you're at. But you want to have the same type of mindset in a way of like, why would you go to a department store and buy that shirt at the highest price they're ever going to sell it? Wouldn't you want to wait till it's on sale and then make the purchase, right? Can you talk a little bit about that mentality? Why is it that people as investors, people look at that market that way? I've always found that very fascinating to me.
Yeah, of course, people look at the track record, right? Well, XYZ Corporation is doing really, really well. I want to buy that stock, right? Well, if you bought NVIDIA, on February 1st and you're holding it now, you're not doing so well. In particular, Tesla this year, if you bought January 1st, you're really not doing well.
Right.
So, they always look at the track record and all that stock's doing really well, blah, blah, blah. But again, it's a different mindset in terms of looking at stock versus that favorite shirt dressed in the local department store. They tend to look at things and go, well, listen, they look at the wrong way. So they should look at first things on sale. So to me, right now is a reasonable time to invest. Is it perfect? No. But again, you're not buying the market for today and today only. You're buying the market today and looking for the results 10 years from now.
Yeah.
So because it's come down a little, it's certainly a better buying opportunity than it was. Are we going to have more bumps in the market? Absolutely. No question. I don't care what year it is, what time frame it is, with new political leadership and everything going on, we're going to have more bumps in the market. But again, my biggest and best investor was one who always said, when the market was down, call me up and say, get those amateurs out of the way, Frank, I'm coming in. He would always come in and buy more. Always. Get the amateurs out. I'll never forget that. Never forget that. So that's kind of the way you have to look at it. So again, seize the opportunity.
Yeah. And so I guess my next question for you, because I think the next challenge that goes along with this is, what do you recommend to people to deal with like social influence, like the news media and people who sensationalize everything? Oh, the market's down and everything is, panic and the world is crumbling. What do you advise people? Obviously, having an advisor and having a small group of people around you would be great, right? But what do you advise people to ignore all of that noise? Because it can be easy to kind of get sucked in to what everyone's talking about. And like you said, make that knee-jerk reaction, get out of the market because you're afraid, and you lose out on those long-term gains because you don't stay consistent.
Absolutely. So in my case, I watch two different newscasts every night. One is far left and one's far right. So I kind of get a mix, if you will, in terms of the news.
Yeah.
My wife has a fit about one of them, but I won't go there. And then, of course, I do read the Wall Street Journal religiously. To me, the Wall Street Journal, is probably one of the finest publications you can possibly read. I read it online, and it gives me information I need to know about and to read about and to know what's going on. So I find that to be very, very helpful. But I'm not necessarily a big fan of investment newsletters or, this guy's recommended this, and look at how well he did in this and that and next thing. I don't buy it. I think that a typical person should, if they have enough money, they should have a professionally managed portfolio with an outside money manager, or if they're starting out, just buy an exchange traded fund to get diversification that way. But I'm not one of these guys that is quick to, look at this great idea. No. I'm looking for proven track record ideas. So if you look at a company like 3M, for example, great track record, increased dividends over the years, That's a proven track record. This new initial public offering from XYZ Industries, not a proven track record. I probably wouldn't go there because it's unproven. So I'm looking for things proven, and this book's basically for the starting out investor. It's not from some professional guy who's been doing it for 50 years. No.
Right.
So that's where I'm at with the book.
What about people like that, like fad, like, the latest craze, or like, I'll pick on Bitcoin, or something like that. But people get excited about this, or you hear from a coworker, like they're investing in this and it's doing great. What's your recommendation or advice or any sort of suggestion from an outside source like that?
Yeah, good point. Of course, I'm not really a fan of Bitcoin. I have studied it and read about it, and it's kind of like an artificial currency, if you will. So I'm not really a big fan. Plus, even in yesterday's Wall Street Journal, we talked about the perils, not so much of investing in Bitcoin, but the perils of who do you buy it through, and how's it being stored, and how do you access it, and so on and so forth. Because that area is really opened up to a lot of fraud, if you will. Not necessarily Bitcoin itself, but the people behind it, if you will. So be very forewarned. And of course, I still think that Bitcoin could be a disaster in the making, because people could potentially lose a lot of money on it.
Yeah. In the beginning, when we first started talking, Frank, you mentioned helping people get towards financial freedom, so to speak, or financial independence. In your mind, like, what does financial independence or financial freedom mean to you?
It means, I'll give you a perfect example, and this may sound elitist, but people laugh when they hear this, but my goal was to never buy a Rolls Royce. That's just not me. I don't want to flaunt it, but my goal was to be able to buy it if I wanted it. I can do that. Okay, so that sounds elitist, but yet it kind of drives the point home. I'm not Mr. Flash, if you will. We live nicely, but I'm not Mr. Flash. But I want to have freedom to make the choice myself versus having it made for me. That to me is ultimate freedom. And of course, in my case, right now with my wife, we don't have money worries at retirement. And a lot of people who retire, they have health issues. So if you have health issues and you have money worries, it compounds. They both feed on each other. So the goal, of course, in my book was to have people retire with a comfort level whereby they're not worried about where the next dollar is coming from.
Yeah, it's so good. And can you speak to that a little bit? You mentioned, Rolls Royce or elitist. I think with this day and age, with social media and people seeing what wealthy looks like, sometimes it can look very misleading. It's a big mansion. It's all these fancy cars. It's going on all these crazy vacations all the time. And what is the reality for most people who are able to retire and be financially independent? Are they living that lavish lifestyle when they get there, or how did they get there? Did they get there by spending their way there?
Well, the irony, of course, is that when I left Merrill Lynch, I was managing about $1 billion worth of assets, and we had some very affluent clients in Orange County, and some household names almost in Orange County. And the irony was that I don't think any of them was living this hyper lifestyle, if you will, with the the $20 million mansion on Newport Coast, or the Rolls Royces, the driveways, or whatever. I don't recall any of them doing that. So even though they were very wealthy, and I had some clients in the 9 figures in terms of net worth, in terms of their investment accounts even, you would never know when you met them. So they were down to earth, not ostentatious, not flamboyant, not aristocratic, not elitist. We could have a conversation, and there was none of this, nobody had their nose in the air like an arrogant son of a gun. So that's the client base I worked with. And of course, this is Orange County, which of course can have some people that are, hoity-toity, if you will. So I think that for me personally, I never saw that. And that's probably how it kind of shaped the way I think as well. I mean, we're not where they are, but we're very comfortable.
Yeah. My last question for you, Frank, before you tell us a little bit more about where people can learn about your book and more information about you, is if I'm just, starting out, what's one piece of advice that you could give me? Say I'm living paycheck to paycheck, I've got some debt, money's a little bit stressful. In your opinion, like, what is the best first step that someone like that could take?
Well, I mentioned earlier, I think the bottom line is to figure out how much money you're taking home and where your money's going. Then figure out where you can cut back and take that money and invest it. And of course, also set it up on autopilot whereby the money's coming out of an account every month, bank account going to maybe a savings bank account, and then you move that to an investment firm, if you will. So it's on autopilot, so you're not even really seeing it. And or start with a 401k. Do that for sure. That's the first thing you want to do. Invest it there. When we first started out, we had a house payment, 2 Honda payments, and a rug payment. So I'll never forget we had the rug payment with Beneficial Finance. And kind of when I look back and go, oh my God. So, I know what it's like to be in debt. So I also know what it's like to be the other direction. So I'm very thankful I'm not on the other side of the coin right now. But I do want everybody in this country to be where I'm at, where they can live where they want to live and how they want to live.
Yeah, that's awesome. Frank, where can people learn more about you and what you have to offer?
So thank you. We do have a website called investorsgoldenplaybook.com. Now talk about the book and talk about yours truly. They can even email me, and I can give them some guidance in terms of what I recommend. I will not have specific recommendations in terms of buying an individual stock or what have you, but I can give some ideas in terms of how they should manage their asset allocation mix, how much should go into stocks and bonds and so on, depending upon their age. So I think it can be very helpful. It's a good way to start. And also they can pick up the book on Amazon or Barnes & Noble, what have you, a lot of different websites by now.
Awesome. So it was so awesome to have you on and just share some insight. I love that you've been doing this for 40 years. And again, in this day and age, we've got obviously a lot of younger folks and people coming up and it's just a different world right now. People are scared. People are wondering what they should do. And it's just awesome to have someone here with some real experience and some history.
Yeah, thank you. I appreciate it. Thank you for having me on. I appreciate it. Thank you so much.
Now, if you're ready to break free from living paycheck to paycheck, you want to reduce financial stress, you want to build savings and finally pay off debt for good. But again, maybe you're not sure where to get started. Don't worry, we've got you covered. Simplify My Money is sent to you each Sunday to your email. It is your step-by-step roadmap to better financial control, so you'll learn easy-to-follow strategies to manage your money effectively, stress-free money decisions that will help you simplify your financial life with proven tips that actually work, and you're going to gain the tools and the confidence to tackle your financial goals head on. You can sign up for Simplify My Money by clicking the link at the top of the show notes. Thanks for joining us on today's show, and we will see you guys on the next episode.